Good morning. This is Bloomberg Daybreak Europe. Happy Thursday. I'm Tom McKenzie in London. These are the stories that set your agenda. Asia tech stocks sell off while US and European futures slump as disappointing earnings from AI bellwether Oracle upend positive sentiment following another Fed cut. Ukraine sends a revised peace plan to Washington as President Trump says strong words were exchanged in a phone call with European leaders. Plus, the US seizes an oil tanker off the coast of Venezuela, further inflaming tensions between the two countries. Nicolas Maduro's government calls the move an act of piracy. So two main stories competing for traders' attention today. It's the Fed, of course, and that's fully expected 25 basis point cut that came through yesterday. 3 cents, though. That is the most on the FOMC since 2019. The dot plot's then staying at 1 for next year, so just expecting one further cut next year. Traders, though, still pricing in 2. That's been pulled back from 3 about a week ago, so that has changed and has adjusted. Of course, the language of Chair Powell has been in focus, but again, it's the forward look from the Fed that is still being worked out in terms of what the market implications are. European futures are pointing flat right now. The other key story for the markets, of course, is the tech story around Oracle, and we'll get the details for you on that shortly. FTSE 100 futures also looking for direction, continuing to digest what's come through on the Fed and the tech impact as well. S&P E-minis, after the gains by the end of the close yesterday, currently pointing down sharply lower by 0.8%. And for that, you can blame, arguably, Oracle. Nasdaq 100 futures looking to drop almost 300 points, pointing lower by 1%, a little over 1% right now. Let's flip the board and have a look cross-asset. You did see a move into treasuries with the yields down across the curve yesterday. Today, that continues. Yields down 2 basis points on the benchmark 10-year, 4.12. We know the Fed as well has announced it's going to be buying front-end T-bills, and that is being seen as supportive, potentially up to $40 billion per month. Euro-dollar at 116, the single currency a little softer, down 0.1%. Bitcoin hovering around 90,000. So despite the Fed cut, a little bit of sentiment, souring sentiment is weighing on Bitcoin, currently down 2.3%. And Brent at $62 a barrel, a little softer by 0.4%, with traders keenly keeping an eye on what's happening with Venezuela and the seizing, of course, of that tanker by US authorities. Let's cross over to Asia right now. We know the tech space as well in that region is under pressure. Winnie Su standing by in Hong Kong. Winnie.
Yeah, morning, Tom. Exactly. You can see how really it is that disappointing earnings from Oracle dragging the Asian stocks, especially the tech sector here today. With SoftBank leading losses in the region, you can see the stocks are down about 7%. And especially with that close ties with Oracle and OpenAI. And investors are really concerned about how CAPEX and revenue both were worse than expected, and that the monetization path for AI might be slower than expected. SK Hynix here, though, have a bit of a different news. It got that investment alert from the Korea Stock Exchange on margin trading, especially after that big run that the stock has seen so far this year. Now we take a step and zoom out and take a look at how this Oracle news has been impacting Asian stocks throughout the day, as it really changed the dynamic and the narrative of Asian stocks. As you can see here, we've got that intraday chart. Actually, stocks were happily up earlier in the morning, especially with that Fed rate cut and how it came with a combination of expecting a stronger U.S. economic outlook and a softer inflation print. So that really bodes well with Asia stocks and currencies. However, that really took a turn, and we saw a reversal of gains into the red later on as technology shares continue to drag. We saw indices in Taiwan, South Korea, and also Japan turning into the red. So we take a look at how the Japanese market is doing as you flip the board and take a look at cross asset. Yes, stocks are down. Japanese yen kind of hovering, still holding on to its gains after that, after strengthening overnight due to the weakness in the dollar that we saw. However, the highlight here really are the yields. You can see that yields are flat, dropping over the curve, over the different curves, and that's really driven by how we've got that 20-year bond auction with the strongest demand since 2022. And it goes to show how investors' appetite for JGBs are still quite strong, especially with yields at these current high levels. Back to you, Tom.
Yep, that Japanese bond auction well received by investors. Winnie Su in Hong Kong, thank you. To a broader look on the tech story then, and Oracle shares falling more than 10%, as you can see, 11.5% in extended trading after the company reported a jump in AI spending on data centers and equipment. It follows fiscal second quarter earnings, which fell short of analysts' estimates. Matt Bloxham, senior analyst for Bloomberg Intelligence, joins me now with the analysis and the details. Matt, what stood out for you? Why the disappointment from Oracle?
Yeah, I think there's a couple of things going on here. One is that they massively ramped their capital expenditure outlook for the year, so now looking for $50 billion to spend. That's $15 billion higher than the early estimate. So,
$15 billion higher than the earlier estimates.
So, like, kind of a more than 40% increase. And I think, in a market where everybody was already kind of getting a bit concerned about how much some of these big tech companies are spending on infrastructure, and that the revenue growth is strong but it's not accelerating, that there's a mismatch between the timing and scale of the investments and when that return is going to come through. And I think particularly with Oracle, so much of their kind of forward revenue opportunity and revenue pipeline is tied to OpenAI, plus a few others. It's kind of huge concentration of risk around this kind of big transition. So I think that spending increase, combined with their big debt load, over $100 billion of debt, cash flow negative for the quarter to the tune of $10 billion. In the short term, the numbers look ugly, and investors are being kind of sold a promise essentially, and not so much delivery yet, certainly in terms of cash flow generation.
More than $100 billion worth of debt, cash flow negative by $10 billion US dollars. So what's the turnaround story for Oracle? When do you and the team expect that gap to close in terms of revenues and the spend on capex, if indeed it does?
Yeah, I mean, I think maybe kind of second half of next year, maybe into 2027. I think, as we spoke yesterday, for me, it's about enterprises moving from testing AI to investing in it at scale. And I think we're not seeing too many companies at that point, and I think more of them will get to that point during 2026, and that then flows through in the shape of extra demand for OpenAI, extra demand for Oracle, more revenue. So I think that's the kind of the big thing we're looking for. I think in the near term, Oracle is on a mission to kind of soothe investors' concerns about the leverage exposure, the commitments they're making, not just in terms of data center build out, but the leases on property they're taking out. They said yesterday that they're committed to an investment grade rating. I think they're going to have to do a good job on the post-results roadshow to kind of convince investors that they're kind of managing all these competing demands on the business and that cash flow, so that nothing spirals out of control.
Okay, really interesting, and breaking down the numbers for us with the context. Matt, thank you very much indeed. More patience, it seems, required from investors in Oracle so far. They're not showing much patience. Matt Bloxham from Bloomberg Intelligence, thank you. Let's get to the Fed then, the macro, of course, the monetary policy story of the week, of the month, delivering its third rate cut in a row, with policymakers maintaining their outlook for just one cut next year. Fed Chair Powell voicing optimism that the US economy will strengthen as the inflationary impact from tariffs fades away.
Today, the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. Available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months. So I don't think that a rate hike is anybody's base case at this point.
Well, let's bring in Bloomberg's Valerie Teitel right now. Val, walk us through the decision then and the market reaction.
Well, we might have just seen last night the last cut of Powell's tenure. He very much signaled that the Fed is on pause, and in the press conference, he hinted that it could be an extended one at that. He said in the statement that they are well positioned to wait when it comes to more economic data to come in, and at least the changing of the statement, they said they would consider the extent and the timing of additional adjustments. And that is the same kind of language that they had used previously in the cycle to give a hint that they are on an extended pause. So the market is very much thinking this could be the last cut of Powell's tenure. He has 3 more decisions to go before stepping down in May. The one very surprising thing, I think, to the market was how positive not just Powell was, but the entire committee was on 2026 economic growth. It was an upgrade to GDP forecast of 0.5% to 2.3% for 2026. And off the back of that, there was no upgrade to inflation. So in some ways, Powell is giving us a hint that he is expecting a productivity boom next year. That's a growth boom that doesn't entail any further inflation. And in fact, on inflation, he seemed rather calm and confident that core inflation is making its way back to target. He didn't sound as worried as he had been in previous meetings earlier this year. Now, some of that more hawkish guidance on rates was overshadowed by the reserve management purchases that were also announced. It seems that the Fed is concerned about the fact that we have seen the Fed funds rate move to the higher end of the band, in some way giving us a hint that liquidity is tight headed into year end, and they want to get ahead of that by announcing $40 billion of T-bill purchases in the next month, starting on Friday. So this was a bit of a shock to market participants. I don't think they had expected the Fed to move so quickly on the plumbing of the financial system in the front end ahead of year end. So that really did lead the market reaction. We saw 2-year yields fall some 7 basis points. The equity market reacted positively to that announcement. We saw a move in gold as well, as this is an expansion of the balance sheet. You know, you could call it QE if you want to, but it's more about the plumbing of the financial system at the very front end of overnight repo. So that did cause a lot of the market reaction yesterday. The other thing that I thought that was interesting is that he very much downplayed the data next week. He said that November data could still be distorted. So in some way, it's trying to get the market's focus to the data prints that we're going to get at the beginning of next year versus the delayed CPI and non-farm payrolls releases that we're expected to get next week.
OK, less important then, arguably, at least that's the take from Jay Powell around the data dropping next week because of some of those issues. President Trump, meanwhile, taking and giving us his view, once again, of course, on the Fed, criticising, not for the first time, of course, unlikely to be the last, Fed Chair Jay Powell. Once again, take a listen.
The head of the Federal Reserve is a stiff, and you fight that. It's amazing. We fight that, and yet interest rates are going down, except with him, not too much. He did a rather, I would say, a rather small number that could have been doubled, at least doubled.
OK, a number that could have been at least double. Is President Trump overlooking the relative strength of the U.S. economy? He's at odds, clearly, with the dissenters on the FOMC.
Yeah, and I think this is getting markets worried that we're careering towards the worst-case scenario, that we have markets pricing in maybe hikes by May of next year when Powell's term ends and Trump puts in a new dovish Fed chair. That kind of situation we were given a hint of. If you take a very close look at the dot plot, Tom, there are actually 6 of the 19 on the wider committee that did not want a cut yesterday. Now, the dot plot is submitted before the meeting begins. So, again, some of them could have been swayed during the 2-day discussion, during the 2-day meeting. But it does seem to be that there are a growing number of Fed officials that do not want the Fed to keep reducing interest rates. And there were some, even on the dot plot, who don't want an interest rate reduction next year. So it's interesting that we're seeing at least some on the Fed tilt to the more hawkish side of things, where we're still getting this political pressure from Donald Trump to lower interest rates. Now, one thing I can say about that is the one dissenter that did add on to Schmid's dissenting vote in order to keep rates steady was Austin Goolsbee from the Chicago Fed. He has talked a lot previously about this AI productivity boom. He's worried it could lead to higher services inflation. And we did hear a lot of that from Powell in the press conference. So I think that was a big part of the discussion yesterday, this kind of productivity activity boom that we're seeing on the back of AI. You can call it the jobless expansion, because Powell is still characterizing the labor market as extremely weak, but upgrading growth on the back of that. A lot of that has to do with the data center investment that we've seen, the fact that consumer spending is still staying strong, even though we have this backdrop of a weak labor market. That kind of conundrum perhaps will be more explained by AI, but I think there is a lot still to be debated about how AI is impacting not just GDP, but the wider labor market as well.
OK, the AI, and a central theme, of course, for this Federal Reserve as well, as they think about that productivity, potential productivity gains that could come through for the US economy in 2026. Bloomberg's Valerie Teitel breaking it down smartly as ever for us. Coming up, tensions, meanwhile, between Venezuela and the US escalate over a seized oil tanker. More on that next. This is Bloomberg.
I don't know what the president's intentions are. We've been in Venezuela for the last 100 years. Our presence there, we believe, is important for the local economy, the regional economy, the people of Venezuela. The Venezuelan oil is sought after by U.S. refiners, and we operate there in full compliance with all U.S. law and sanctions. We're in discussions with the administration to ensure that we stay in compliance.
The Chevron chairman and CEO speaking to Bloomberg yesterday about discussions with the Trump administration on remaining compliant with sanctions on Venezuela. Tensions, meanwhile, between Venezuela and the US continue to ratchet up. In the latest move, American military forces intercepted a seized a sanctioned oil tanker off the Venezuelan coast.
We've just seized a tanker on the coast of Venezuela, large tanker, very large. Largest one ever seized, actually. And other things are happening, so you'll be seeing that later, and you'll be talking about that later with some other people.
La República Bolivariana de Venezuela.
Venezuela denounces and repudiates energetically what constitutes a blatant theft and an act of international piracy, announced publicly by the President of the United States.
For more on this story, let's bring in Bloomberg Energy reporter Stephen Stupczynski. Stephen, why did the US seize this tanker off the coast of Venezuela then?
Well, I think, if my colleagues in the U.S. have been reporting that this is mostly due to their expectation that it was actually going to bring the oil to Cuba. Now, of course, the Trump administration did say that this is already a sanctioned vessel. They're trying to ratchet up pressure on Venezuela. And so they did this, they sort of really upped the pressure on that government and also the dark trade in general by seizing it. This was a surprise move. A lot in the market weren't expecting the Trump administration to do this, and this does show more pressure on the government for Venezuela. Now, of course, if they were going to deliver this crude to Cuba or not, that's a big question. This is a very large crude carrier. Trump was correct. It is big, 2 million barrels of oil, and it's abnormal to send carriers this large to Cuba. So where was its actual destination? It's still unclear. Was it actually going to China? But either way, the Trump administration did decide to do this, saying that because the ship was already sanctioned, we have the authority to board it and take it, as you see with these pretty striking images that were posted on social media.
2 million barrels. 2 million barrels. Yeah, that is a sizable tanker. What does this mean for the oil market, Stephen, then? I'm looking at Brent prices a little softer in the session today.
So this is the thing. If this sort of thing were to happen, let's say 2 years ago when the oil market were tighter, I think you would have seen a pretty large spike in Brent and WTI prices. But we're in a time when it's really frothy. We're entering a glut period. Now, Venezuela is a pretty sizable exporter of oil. Despite the sanctions, I think they're shipping about 500,000 barrels a day, a lot of that going to China and elsewhere. But through dark fleet vessels, but that is still barrels on the market that while they are sanctioned, they're able to find their way there, and the U.S. hasn't really taken any cracking down measures, which is why taking this ship would have an impact theoretically on the flows, because will ships now want to dock at Venezuela? Even if you're a dark vessel, are you worried about getting taken by the U.S. government? Are you worried about getting boarded? So while this is something that does tighten the amount of output from the country potentially, the market has a lot of capacity to replace it. China has other places to go. We're in a time when U.S. output is very strong. OPEC Plus has been increasing output over the most of this last year. And demand in China actually hasn't really grown as much as some in the market had been expecting for a few years back. So you are entering a period which the IEA calls quite a large glut in 2026. So prices have been, they rose a little bit today, but they're down a bit and they are weaker.
Yeah, just shy of $62 a barrel right now on Brent. Bloomberg, Stephen Stratinsky. Stephen, thank you. Now, Venezuelan dissident, meanwhile, Maria Corina Machado, appeared in Oslo hours after her daughter accepted the Nobel Peace Prize on her behalf. The Institute said that Machado had undergone, quote, a journey in a situation of extreme danger to reach the Norwegian capital from her place of hiding. Machado leads the resistance to President Nicolas Maduro's autocratic rule. Leaving the country carries a risk of not being allowed back in, which might effectively leave her stuck in exile. Now, Mexican lawmakers have given final approval for new tariffs on Asian imports, broadly aligning with U.S. efforts to tighten trade barriers against China. The bill imposes tariffs of between 5 and 50% on more than 1,400 products from Asian nations that don't have a trade deal with Mexico. China's Ministry of Commerce has criticized the tariffs, calling them a mistake. Coming up, the mega media merger gets messy as President Trump weighs in on the future of CNN in the battle over Warner Brothers. We will have the latest on the fight between Paramount and Netflix. That is next. This is Bloomberg. Now, Disney Entertainment's Dana Walden believes the company can coexist with streaming giant Netflix. Walden, who serves as co-chair of Disney, spoke with Bloomberg's Emily Chang.
Well, it's very clear Netflix has done an extraordinary job, and they really have developed into a utility, right? They, in many situations, that is the place you go when you don't know what you want to watch, but you're going to watch TV.
Would you say there's a difference in terms of quality versus quantity as well?
Oh, no question. No question. We've never been in the quantity. We're not trying to create a fire hose of content. We're trying to curate.
That said, Netflix shares are up 80 times. Since the start of the streaming boom, Disney shares have about doubled. And Netflix's market cap is about twice the size of Disney now. What's your message to investors?
Both services can coexist, and I think we keep making quarterly gains, both in terms of revenue, NOI, in terms of subscribers and engagements. Virtually impossible to start from scratch, and it's also really difficult to do it without that IP.
And you're trying to lean into more global and localized content. What does that mean? What markets are on the table? What's off the table?
Disney Plus is currently in over 150 countries. We are not producing local originals in all of them. We are picking key countries in each of the regions and developing original content there.
Well, you can watch Emily Chang's conversation with the Disney Entertainment co-chair and a cast of Disney stars, including Kim Kardashian, on the circuit, airing later today on Bloomberg Television. You can also stream it on Bloomberg Originals. President Trump, meanwhile, has signaled he would oppose a Warner Brothers deal that does not include new ownership of CNN, creating a potential wrinkle for the bid from Netflix. The streaming giant's plan includes a spin-off of Warner Brothers cable channels. Paramount, for its part, is trying to buy the company outright for $30 a share. If successful, Paramount would control both CNN and CBS News. Coming up, fallout following the Fed's rate cut. We're going to have analysis from Aneeka Gupta, Director of Macroeconomic Research at WisdomTree. That is next. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. Happy Thursday. I'm Tom McKenzie in London. These are the stories that set your agenda. Asian stocks sell off. US and European futures slump as disappointing earnings from AI bellwether Oracle upends the positive sentiment following another Fed cut. Ukraine sends a revised peace plan to Washington as President Trump says strong words were exchanged in a phone call with European leaders. Plus, the US seizes an oil tanker off the coast of Venezuela, further inflaming tensions between the two countries. Nicolas Maduro's government calls the move an act of piracy. So, the markets on the back foot this morning. There were some gains by the end of the close on Wall Street yesterday after that third consecutive cut from the Federal Reserve. And what we heard, of course, from Chair Powell, the dot plots looking at one additional cut next year. The market's still pricing in two. But, of course, there were 3 dissenters amongst the Fed voters. That is the most since 2019. So uncertainty into next year with growth called higher as well by the Fed. European futures currently pointing lower by 0.1%. FTSE 100 futures here in the UK looking to drop 13 points. S&P E-minis then, after closing in the green yesterday, pointing sharply lower today, down 0.9%. And part of that is down to the Oracle story. The CapEx spend and revenues coming lower than expected. Nasdaq 100 futures pointing lower by more than 300 points, looking to drop 1.2%. Again, you can tie that to the Oracle story. Let's flip the board and have a look cross-asset. You did see Treasuries rallying yesterday, particularly at the front end, on the news that the Treasury, the Fed, would start buying T-bills from as soon as Friday, up to $40 billion a month. So that did support the Treasury market, and you're seeing that continue today. Yields down 2 basis points on the 10-year at 4.12. Euro dollar at 1.16, weaker on stronger dollar in the session. Bitcoin hovering around 90,000, down 2.3% now for Bitcoin, of course, a gauge of risk sentiment. And Brent just below $62 a barrel, down 0.5% as traders continue to monitor, of course, the implications of that tanker seized by US authorities off the coast of Venezuela. Let's get then to a more detailed look at these markets with the Fed and Oracle in focus. US stock futures then, as we've mentioned, of course, falling on the Nasdaq 100, contracts down more than 1%. Oracle, of course, spoiling the Fed rate cut party if it was a red Fed rate cut party. Let's bring in MLive executive editor Mark Cudmore right now. Mark, let's start with the Fed, I think. The descent, the most that we've seen since 2019, the upgrades to the growth forecast for next year, pretty significant. Inflation still off target. You're not hitting that until 2027, and yet they cut. How much clarity is there about this Fed going into 2026?
It's a good question because it seemed like this was a wonderful Fed message for stocks. They were being dovish despite growth being okay, inflation being under control. And sure, while they weren't kind of committing to a bunch more cuts next year, they certainly didn't surprise hawkishly, which had been the narrative. So in real time, I was watching kind of the coverage last night. I wasn't contributing to it, but I was watching it in real time. It seemed like this was a positive message for stocks. We then kind of got the Oracle news, and that kind of seemed to make us much more negative. But in Asia time this morning, we were originally kind of going, yeah, Oracle's a negative, but that'll be dismissed because the Fed message is more important. Now suddenly the price action's much worse, and in hindsight, people are blaming Oracle. I'm not convinced by that explanation. I think actually what partially it is that people are realizing that there's so much uncertainty over the Fed that they don't really have conviction what the right path is. And that uncertainty going into this time of year is encouraging people to just take money off the table to de-risk. And that's why we're seeing a little bit of a risk-averse session, even though I wouldn't want to read too much into it.
OK, so de-risking on the uncertainty. Mark, what are other asset classes telling you? I mean, the Bitcoin moves sharply lower. Maybe that aligns and that supports your view then, that this is a risk-off moment and traders and those with exposure to the markets are taking some risk off. If that is the case, where does that leave your view into next year on the uncertainty around the Fed, the new chair, of course, but at the time when some of that stimulus comes through in the form of the tax bill in the US?
So The bigger picture for me, I'm still very bullish on stocks into next year in terms of I think we make fresh highs. I think the AI bubble still has much more to inflate. I think that the fact that the Fed is buying Treasury bills, that the Treasury are going to issue more Treasury bills to kind of encourage fiscal stimulus and the Fed's going to buy them, this is all a way of pumping up the stock markets. I'm in the camp that ultimately the AI bubble has more to inflate in 2026. That said, as I've been for the last number of weeks, I'm a little bit nervous in the short term. I'm still nervous this side of Christmas that it's going to remain choppy and difficult. I don't think this is the time to get enthusiastically on board that kind of 2026 bullish story. So I think the price action is very negative. I think you saw silver surge to another fresh record high this morning and then reject that. Gold's back negative now. Crypto's negative. If this was supposedly a dovish Fed, well then why are all the kind of the anti-fiat plays doing so poorly? So the price action is quite negative in the short term. And I think that while it's low volumes, we're going to holiday period and you wouldn't want to read too much into it. I think that reflects the fact that this side of Christmas, I'm not convinced that it's going to be easy for stock markets to make more gains.
OK, anxiety leading into the holiday period, but broadly more positive longer term on the equity story. MLive Executive Editor Mark Cudmore. Mark, thank you for the analysis on the back of the Fed and Oracle, of course. For more, let's bring in Aneeka Gupta right now, Director of Macroeconomic Research at WisdomTree. Aneeka, thank you for your time and thank you for waiting patiently in the wings for us. What is your reaction? How are you adjusting, looking to adjust your views on the back of what we've heard from the Fed?
Yeah, I see this as a very hawkish cut delivered by the Fed, where we've seen a rate cut, but it's also been paired with guidance that keeps the door very narrowly open for further easing. And that was quite evident in the summary of economic projections, which just points to one further cut as the median for 2026 policy profile. So that reflects, that the committee thinks they're very close to neutral, to the neutral stance at this point in time. The other 3 points I would say that did stand out was, we have a very split FOMC with 3 formal dissents. A message with further cuts are, far from automatic. They're going to be very data dependent. And we've also seen Jay Powell further allude to the fact that interaction between tariff-driven inflation and a softening labor market is what they're really trying to tackle.
On the dot plot question, Aneeka, and you referenced that, the forecast from the FOMC, at least the projections that you get just one more cut next year. Markets still pricing in 2. Do those views converge? Do markets pair those bets in the days and weeks ahead?
This is where we see the volatility lying especially for risk assets into 2026. The Fed is sticking to their path of one cut, whereas the market is pushing for more. This is why equities were very, very more risk on overnight, as we expect a much more easier policy path to be taken by the Fed. And I think that's where we're likely to see a lot of friction in equity markets and paving the way for a lot more volatility.
What do you make of the decision to restart these T-bill purchases? Part of this is about plumbing, it's about liquidity into the financial system of the US. But Treasury's clearly rallied partly on that yesterday, and that continues today. What are the implications of that decision by the Fed?
Yeah, that was the dovish surprise that we did get from a very hawkish meeting. Their announcements that they would start at a size of 40 billion concentrated in bills, but they could also include US Treasury coupons with maturities out to 3 years. So that essentially tells us that, they believe at this point in time, a lot of the risk management that has been put in place has been quite sufficient, but now they want to ensure that, they do try to manage liquidity on an ongoing basis. And this is why I think they've reintroduced that. And I think that brought about quite a dovish surprise for markets in general.
Aneeka, we're getting closer to that neutral rate, and there's a debate as to what that neutral rate is in the US, but we're around 375 right now, following that 25 basis point cut yesterday. Growth projections are significantly higher by the Fed for 2026. We have the tax bill coming into force as well stateside. Is there a reinflation risk in the US next year?
That remains the key uncertainty. On the risk side, Powell did emphasize that tension between weaker jobs gain and tariff-driven price pressures. noting that there is essentially no risk-free path between employment and inflation and the inflation side of the mandate. Now, clearly, for the U.S. consumer, they are now going to be hit with an average tariff rate close to about 4%, now in 2026 rising to an average of about 12 to 13%. So how that impact feeds through the economy, how the U.S. consumer tackles that is, and how it feeds through inflation is going to be a key uncertainty that the Fed is trying to navigate. So there is a risk of inflation reaccelerating, and it's going to be very much dependent on how tariffs play out in 2026.
How does this all tie into your outlook for stocks next year, Aneeka?
Well, especially for equities, Tom, the way we're viewing it is for equities, we're likely to see narrow equity risk premium, greater regional differentiation. So we're going to see, Japan on one end normalizing policy, whereas the rest of the world easing monetary policy. And there's going to be more dependence on earnings delivery rather than just multiple expansion, which the market has relied on, for a lot of 2025. So that's where we see a lot of stock picking coming into play, focusing on the right factors, the right jurisdictions, and also allowing for diversification outside the US, which was one of the winning strategies for 2025.
Aneeka, is Oracle the canary in the coal mine around AI capex spend?
Well, it clearly was, a big cautious bellwether for the markets overnight. I think the big concern here is they are promising to deliver a lot more. And the big risk right now is, they are in a negative cash balance territory. They have an enormous amount of debt on the balance sheet. And investors really want to see how they navigate that moving forward. And this could be a further sign of other AI-related companies taking on a lot more debt over the coming years, and whether they're actually able to deliver on that promise of, a much higher earnings multiple.
Aneeka Gupta, Director of Macroeconomic Research at WisdomTree. Always appreciate your insights. Aneeka, thank you very much on this very hawkish cut. The take, of course, from Aneeka Gupta. Now, some other stories making the news this Thursday. Google DeepMind is set to open its first research lab for discovering new materials, like those used in batteries or chips, as part of its push to apply AI to more scientific fields. The facility, which will open in London next year, is the centrepiece of a broad partnership between the Alphabet-owned company and the UK government. DeepMind is run by Nobel Prize winner Demis Hassabis. In a statement, Hassabis said discovering new materials is one of the most important pursuits in science. And Bloomberg has learned that Meta is working to pivot its AI focus toward a model that customers would pay to use. Sources say a model, codenamed Avocado, is expected to debut sometime next spring. Mark Zuckerberg is also said to be getting personally involved in day-to-day work. The move would mark the biggest departure to date from the open-source strategy the company has touted for years, and comes as Zuckerberg assigns billions of dollars to the company's AI efforts. Meanwhile, the chief executive of chip equipment maker ASML believes the huge investments being made in AI infrastructure are justified. ASML is Europe's most valuable company and a crucial pillar of the global AI supply chain. Its gear underpins major AI breakthroughs, from NVIDIA's cutting-edge semiconductors to ChatGPT. Speaking last month, Christophe Fouquet told me on Bloomberg Tech Europe there is logic behind the massive spending by the likes of OpenAI.
I think the investment makes sense overall, because you cannot play in AI without investing in hyperscaler. And there may be even a few cycles of investment, because the investment today is done on certain chips. The chips in 2-3 years from now, if you look at NVIDIA announcement, they will be a lot more powerful. And people may be tempted again in 2027 to invest again in hyperscaler to make use of those chips. So you have different cycles, and you have a bit of a arms race, because if you don't invest today, you're out.
Well, you can watch more of that exclusive interview with the ASML CEO tomorrow on the next episode of Bloomberg Tech Europe. We'll also get his views on AI bubble fears, or Western tech restrictions on China, and Europe's chances in the AI race. That's at 6:30 a.m. UK time here on Bloomberg TV. You can also watch on the terminal, Bloomberg.com and YouTube. Coming up, Ukraine sends a revised peace plan to Washington after US President Trump speaks with European leaders. We discuss the latest on Ukraine next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Ukraine has sent a revised peace plan to Washington as President Trump held a call with European leaders. Trump says pretty strong words were exchanged with the leaders of France, UK and Germany while discussing the war. Bloomberg's chief Europe correspondent Oliver Crook joins us now from Brussels. What exactly happened yesterday then, Ollie?
Tom, it was a super busy day yesterday for everything Ukraine. I mean, you're starting with that peace proposal, which we understand got revisions from the Europeans and the Ukrainians. The Ukrainians then shuttled it over to the United States. We understand that that happened at just about the same time that Donald Trump got on the phone with a number of European leaders to have a number of discussions about the sort of path forward. And speaking on that call, as you just alluded to, he said that they discussed Ukraine in pretty strong words, the President of the United States. We'll see what happens next. We're waiting to hear answers before we progress. What the Europeans would like to see is a trip, actually, from Donald Trump to Europe. Trump said that that was proposed by European leaders, but before he were to embark on anything like that, he would like to make sure that there has been meaningful progress made, and that is a trip that would not be in vain. Of course, for the European perspective, getting in the room with Donald Trump is so absolutely vital. We see the difference that a sort of meeting between two leaders, Zelensky, Trump, and a number of other European leaders, what kind of difference that can make in the tone that we hear from Donald Trump. Yesterday also, Tom, we had a call between Zelensky, a number of top Ukrainian officials, Scott Bessent from the U.S. Treasury, Jared Kushner, and Larry Fink, the CEO of BlackRock. That was all about reconstruction the day after in Ukraine. And Zelensky saying that that was basically could be considered the first meeting of the group that will work on a document concerning reconstruction and the recovery of Ukraine. So we have the first document, the 20-point plan, the second document about recovery. That leaves, Tom, a third document that we understand is circulating, and that is probably the most important. That is all about the security guarantees, the mechanisms by which Ukrainian sovereignty is guaranteed going forward, so there's no invasion any longer in the future after a peace proposal. That being said, Tom, we still don't know what's inside of that, and I suspect that is one of the most complicated and biggest sticking points in this whole negotiating process.
OK, three key documents for now being kept pretty tightly under wraps. And European finance ministers, meanwhile, are meeting today. Ollie, what are you watching for from that meeting?
So, Tom, for us, from the sort of Ukrainian perspective, it's all about the Russian assets. Of course, that's a final decision that rests with the leaders. That'll be decided next week. But, of course, finance ministers will exchange views about that today. And we'll be speaking to a couple of those finance ministers today to get an update on where exactly we stand. And just a reminder, there's also the EU is sort of rushing through emergency powers to the EU in order to circumvent Hungary to be able to hold those assets indefinitely. Currently, how it works, Tom, is you get a rollover of 6 months to continue to hold the assets within the EU, and Hungary every 6 months there's a big objection, there's a big sort of circus around it, and finally they get on board. This would effectively use emergency powers within the EU to circumvent Hungary, which is quite contentious, but that way the Russian assets would be immobilized permanently or indefinitely so that the Europeans could do what they would like with them. And reminder here, 90 billion euros is what they're targeting to get to Ukraine. That would fund Ukraine about 2/3 of the way going forward for the next 2 years. That being said, Tom, we were doing a sort of study about how much aid has actually made it to Ukraine in terms of the dollar value. Ever since the United States has pulled back from it, it means 2025 will be the year in which it will fall way below the average of the amount of support that the Ukrainians have got. That means the Europeans would have to fill a gap of 9 billion euros this year to get it back up to the average of support that they've been getting for the last few years. And as we know, Tom, we're talking every couple of weeks, it feels like, about a government falling in Europe because of how strained the budgets are. That just sort of underlines how important it is to get motion on these Russian assets for the Europeans because they can't fund it themselves.
OK, let's see if there is further progress on that front later today and then to the leaders meeting, of course, next week, to your point. Bloomberg's chief Europe correspondent Oliver Crook in Brussels. Ollie, thank you for that update. Oliver will be speaking, meanwhile, with Portuguese Finance Minister later, about the use of frozen Russian assets and the election for the Eurogroup president. That interview at 8:45 a.m. UK time, so stay tuned for that conversation. Former UK Prime Minister, meanwhile, Theresa May, has downplayed the threat posed by Nigel Farage's Reform UK party, which currently leads in opinion polls here in the UK. In a wide-ranging interview with leaders with Francine Lacqua, May also discussed her handling of Brexit, global diplomacy and the future of the Conservative Party.
Reform makes a lot of noise. Reform has now, is it 4 or 5 MPs currently?
But in the polls, they're doing very well in the polls.
But the only poll that ever counts is the general election. That is some years away.
You don't seem to be threatened by Nigel Farage.
There's always a role for a centre-right party. And I think that's what the Conservative Party is about. Nigel Farage's economic policies, frankly, they're all over the place. It's all very well doing well in opinion polls, but when it comes to it, people want to ask who should be in government. Critical to that will be the economy.
And you can watch the full interview tomorrow, 5:30 p.m. in the UK, or on the Bloomberg website and on the terminal from tomorrow morning. There's a lot more coming up. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So, the most dissents from the Fed yesterday since 2019. 3, 2 on one side, 1 on the other. You can see the dissent numbers here. These are represented in these white bars. Again, you have to go all the way back here to 2019 to see a similar number of dissents amongst the FOMC. The blue bar showing the number of rate cuts that we've seen, where rates currently are. Currently, of course, at 375 after that 25 basis point cut. But if you expected clarity, if you expected a clear steer into 2026 from the Fed yesterday, that is not what you got. You got an upgrade in growth. You got inflation that's not coming down to target until 2027. And you got a dot plot forecasting an additional cut next year, markets pricing in 2, dissent at the FOMC, of course, and a new Fed chair as well. All of that leading to clouds and uncertain outlook for where the Fed goes in 2026. And maybe that leads to further volatility in the equity markets. Let's flip the board and have a look at something that is certainly leading to some volatility in the equity markets. And that is Oracle. The disappointment around the mismatch between the CapEx spend of this company and the revenues that came through. The earnings coming through yesterday, of course. And this divergence now between the fortunes of Alphabet and Oracle. Oracle, represented by the white line, down about 30% since its peak in September. Still up 30% year to date, but down since 30% since that peak in September. The fortunes of Alphabet, given the progress around Gemini 3, is represented by the growth of that stock. The upside coming through for Alphabet, up more than 70% year to date. We'll see if that trend continues then. Oracle in focus and weighing on NASDAQ 100 futures this morning and the S&P 500 as well. The opening trade is up next. They'll walk you through all the analysis around the Fed, around Oracle and plenty more. Stay with us. This is Bloomberg.